Welcome, wealth builders, and welcome back to 100 Wealth Building Secrets with James Marshall, the podcast where we break down the strategies that turn a paycheck into a portfolio and a portfolio into a legacy. I'm James Marshall, founder of Marshall Wealth Management and author of The Hive Multi Generational Wealth Building Strategy. If you've been with me for a while, you know The Hive is built on one core ideal. Wealth isn't something you accumulate, it's something you architect. So it survives you and multiplies for the people who come after you. It's about generational wealth, multi generational wealth. Today's episode is one of the most practical tools in that architecture. We're talking about establishing a private family bank. Now, I've spoken on family banks in past podcasts, so this should be familiar to some of you. This is a structure your family can use to handle car loans, personal loans, and cash reserve management, and all while keeping the interest, the discipline, and the decision making inside the family. So let's get into it. Let's start with the question of what actually is a private family bank because the name throws people off. A private family bank is not a chartered bank. You're not getting a FDIC number. You don't need a building or a teller. What you're building is a structured pool of family capital, often housed inside a dedicated entity, such as a trust, or in some cases, a properly structured whole life insurance policy or index universal life policy that exists for one purpose: to lend money to family members under family controlled terms instead of sending that borrowing need out to a commercial bank and credit union, or worse, a high interest lender. Now, this episode is called Build Your Own Bank Using a Private Family Bank Strategy for Car Loans, Personal Loans, and Cash Reserves. And I have a quick question for you. The last time you say all of that over again, I have a quick question for you before we even get into today's episode. The last time you or your family member or someone in your family financed a car, where did that interest payment go? Did it go to you or did it go to the bank? Well, for most families, every single car loan, every personal loan, every I'm a little short this month loan, that interest leaves the family forever. It goes to a stranger, a bank that doesn't know your name, doesn't care about your goals, and definitely isn't trying to build your legacy. Today, we're talking about how to flip that. We're talking about how to become the bank. Let's get specific because I want to leave you with something on this episode where you can actually use. Uh, there are three core cases. Say all that over again. Let's get specific. Say that. Let's get specific because I want to leave you. I want to leave you. Say that again. Let's get specific because I want to leave this. I want you to leave this episode with something you can actually use. There are three core use cases I see families implement most often. Number one, car loans. The average car loan today carries an interest rate that, depending on credit, can run anywhere from 6 to 12% or higher. And dealership financing is often the worst of it all. Now imagine instead your adult child needs a car. Instead of financing through a dealership, they borrow the money from a family bank at a rate the family sets. let's say 5%, fully documented with a real promissory note, real payment schedule, and real consequences for missed payments. So they're learning how to repay debt. Here's the key: that 5% interest doesn't evaporate into the lender's quarterly earnings report. It flows back into the family bank. It becomes capital available for the next family member's needs. The family member still the family member still builds the discipline of making real payments on real schedule. That part doesn't go away, and it shouldn't. This isn't about handing out free money. It's about keeping the economics of lending inside the family system. Number two, personal loans. This is broader: medical expenses, debt consolidation, a down payment bridge, even funding a family member's small business idea. The private family bank lets you apply real underwriting discipline, yes, even within the family, while avoiding a 18 to 29% credit card interest rates or predatory short-term loans from lenders. I always tell families structure these loans like a bank would: written agreement, interest rate, repayment schedule. This protects relationships as much as it protects money. Some of the worst family conflicts I've seen in 250 plus family. Mm, say that over again. Some of the worst family conflicts I've seen in 250 plus client relationships didn't come from a lack of money. They came from an informal $3,000 loan with no terms, no timelines, and no clarity. The private family bank removes the ambiguity that usually does the damage. Number three, cash reserve management. This is the piece people underestimate. A family bank isn't just for lending, it's also a centralized reserve that smooths out the bumps every family hits: a car repair, a job loss, a medical deductible. Instead of each individual household scrambling to self insure their own emergency fund, often inadequately funded, the family pools reserves the family pools reserves capital and manages it collectively with clear rules for who can access it, clear rules for what the purpose is, clear rules for what the terms are. Done well, this reserve isn't just sitting idle. Depending on the structure you use, you can position it to grow, sometimes through a properly designed permanent life insurance contract, sometimes through a conservative liquid investment allocation. The goal is to have the capital available when needed, but also allow it to continue to grow in the meantime. High yield cash reserve accounts are good for this, even short term bonds, but managing the cash reserves without restricting the cash reserves. Segment three: how to actually structure it. Now, let's talk about mechanics, because the family bank only works if it's structured properly. I'll walk you through the framework that I use with families. Step one: choose your vehicle. There are a few common approaches: a family LLC, where capital is contributed by family members or a family business and managed by a designated manager, often the family's wealth architect, which can be anyone. It can change up often. As I said in my book, you want to change this out maybe every 2 to 4 years. Families, say that part over again, please. A family LLC, where capital is contributed by family members or a family business and managed by a designated manager, often the family's wealth architect, which in many families is the person playing the role I described in the hive as the queen bee role. Not literally in charge of everyone, but responsible for the health of the whole structure. And this should change from time to time. You can put your family matriarch or patriarch in charge, but that leadership role needs to change from time to time so the whole strategy doesn't get stagnant or thrown out of whack once that person dies. I digress. A dedicated trust, which adds an extra layer of assets protection. Say that again. A, a dedicated trust, which adds an extra layer of asset protection and can be especially useful for multi generational planning. Now, a whole life insurance contract used specifically for its cash value component, which allows the family to borrow against the accumulated cash while the underlying policy continues to grow. This is a strategy sometimes called infinite banking, and is one version, not the only version, but it is one version of a private family bank. Now, when you talk about extreme leverage and truly funding the bank over generations, you really can't go wrong using life insurance policies. Now, the right vehicle depends on your family size, your existing entities, and your goals. This is exactly the kind of decision that should be made with a financial advisor and likely an attorney, not pieced together from a podcast or a Google search. I say that as someone who hosts a podcast, by the way. You need to bring in professionals and get professionals to advise you on this process. Not just a financial advisor and an attorney, but also bring into the mix a certified public accountant. Step two, capitalize the bank. This is simply funding it. It might start small, a few $1,000s from a couple of family members, or it might be funded through a portion of an existing family business's profits, an inheritance, or a structured insurance contract. The amount matters less than the discipline of actually starting. You have to start. Step three, write real rules. This is the step families skip. It's the step that makes or breaks the whole system. You need to have a clear application or request process. Yes, even within the family, it is important for everyone to know what are the steps to acquiring the loan. And it should not change just because it was your favorite nephew that was applying for the loan. Define interest rates, ideally benchmarked to something like the IRS applicable federal rate, so that the loan is respected as a genuine loan rather than, say it over again. It should have a defined interest rate, ideally benchmarked to something like the IRS federal fund rate. So the loan is respected as a genuine loan rather than treated as a gift or tax purposes, for tax purposes. A repayment schedule with real consequences for mispayments. A decision maker or small committee, not a free for all where every family member can independently approve loans. That committee must look at everything and treat each loan the same. That's important. You must have structure and continuity. Step four, document everything. Every loan needs a written promissory note. This is this Every loan needs a written promissory note. This isn't about distrust. It's about protecting the relationship from misunderstandings and protecting the family bank and protecting the family bank's tax treatment. The IRS doesn't look at a family loan. Say it all this over again. Every loan needs a written promissory note. This isn't about distrust. It's about protecting the relationship from misunderstandings and protecting the family bank's tax treatment. The IRS does look at family loans, and a loan with no documentation, no interest, and no real repayment expectations can be recharacterized as a gift, which has a very different tax consequence. So have your ducks in the row. Step five, review and govern it annually. Treat this like you would any institution. Sit down once a year, I would say once a quarter, review outstanding loans, review the reserve balance, and decide together how the bank is performing and where it's headed. Is it loaning out more money than it's bringing in? Know the balance sheet of your family bank. Segment 4, why this matters for legacy. Now, here's why I care so much about this strategy. Here's why I care so much about this strategy beyond the math. Multi generational wealth doesn't usually collapse because of one bad investment. Say that again. Multi generational wealth doesn't usually collapse because of one bad investment. It collapses because the next generation never learned the systems, the discipline, and the language of money that previously was known by the generation before it. A private family bank does something almost no other strategy does as naturally. Say that again. A private family bank does something almost no other strategy does as naturally. It creates a built in, recurring reason for families to talk about money together. Say that in a way that you can understand it. It forces you to talk about money as a collective group. It creates a built in, recurring reason for that. And every loan application is a conversation. Every annual review is a teaching moment. Every payment is a lesson of financial discipline that happens inside a relationship of trust, not inside a stranger's call center. This is the difference between wealth. Say that again. This is the difference between wealth that's just inherited and wealth that's actually transferred. Meaning, the knowledge. Say all that again. This is the difference between wealth that is inherited and wealth that is actually transferred, meaning the knowledge, the habits, and the structures go with it. In the Hive, I talk about building something that outlives you as a single person in the family. A private family bank is one of the most tangible tools for doing exactly that because it forces structure, accountability, and conversation into a part of the family's life that usually is handled in silence, or worse, not handled at all. So, in closing, so here's your action. Say that over again. Just drop out. So, in closing. So, here's your action step for this week. I want you to do something. Say that again. So, here's your action step for this week. I want you to do one thing. Have a single honest conversation with your spouse, your parents, or your adult children about where your family's borrowing dollars are currently going. Not judgmentally, just factually. Who's paying interest right now and to whom? That conversation is the first brick in building your own private family bank. Now, if you want help thinking through whether a family LLC, a trust, or a properly structured insurance contract is the right vehicle for you and your family's situation, that's actually the kind of conversation we have at Marshall Wealth Management. You can find us at marshallyourmoney.com. And if today's episode resonated with you, go grab a copy of the book, The Hive, on audible.com. This strategy is one piece of a much bigger framework for building wealth that actually lasts. So, as always, this episode is for educational purposes. Every family's legal, tax, and financial situation is different. So, before you implement anything like this, sit down with a qualified financial advisor and an attorney who you can structure properly for your specific circumstances. That's it for today. And as always, keep building wealth. Peace.